Here we will learn the preparation of balance sheet. But before that, let's have a few words related to it. As you know, a balance sheet is prepared to ascertain the financial position of a business at the end of an accounting period. It lists all the assets on right side and the liabilities along with proprietor's capital on the left side. Now, let's think whether balance sheet is a statement or an account. Well, yes, it's a statement. And you know why? This is simply because, unlike an account, it is not prepared by following the accounting rules of debit and credit. Also, you can see that there is no word account suffixed to balance sheet. Remember, as we used to do for cash account, machinery account, and so on. Now, let's have the format. Here it is. So here, on this side, we have all the assets, and on this side, these are the liabilities. Now, let's have a close look at each of these items. We will begin with the asset side. Now look here. All these items are regarded as fixed assets. Let's quickly have a glance over the features of these assets. These are acquired for a longer period of time and are used as basic inputs for the production of goods and services. They can be either tangible, that is, they can be seen and touched, like machinery, furniture, or they can be intangible, that is, cannot be seen and touched. For example, goodwill or reputation of a firm. Now next to the fixed assets are the current assets. All these assets are categorized as current assets. Here are a few features. They are primarily acquired for the purpose of resale, and hence are held for a very short period of time. Now, the next we have are the fictitious assets. Items such as deferred revenue expenditure, advertisement suspense, and others are classified under these type of assets. A unique feature of such assets is that these are not convertible into cash. These are normally the expenditure and the losses that are written off over a longer period of time. Now, let's move on to the liabilities side. Here, the very first item is capital. This is the amount that has been invested by the proprietor in the business. As you can see here, some of the items are shown as additions, while others as deductions. These raise the amount of capital, while these ones reduce the capital amount of the proprietor. Next, we have the fixed liabilities. All these items are to be paid off after a period of 1 year. So these are also termed as long-term liabilities. Now, look at these highlighted items. These are different reserves and provisions. All these items are maintained by a firm to meet any future uncertainties and losses. Next, we have these items. All these are the current liabilities. Such liabilities are to be repaid within 1 year, so these are also termed as short-term liabilities. At last, we total both the sides like this. Both these balances should match with each other. This also confirms the accounting equation. That is, all the assets must be equal to capital plus liability.